Good afternoon. My name's Andy Johnson. I'm the Chief Operating Officer at Tenon. We're proud sponsors today's session around climate vulnerability and the protection gap at the ICA's 2024 conference. As an insurance builder and service provider, we were keen to sponsor this particular session as we see firsthand how the gap can have an impact on both people and the communities. And although Australia is well insured compared to other nations, a 35% gap and rising to 50% after a major event can have such devastation on these communities. It's clear that collaboration is needed across supply chain, insurers, the government, and other bodies that are focused on climate resilience. It's important that we look at what the short-term, medium-term and long-term solutions could be. I'm looking forward to today's panel from Allianz, the Actuaries Institute and the Australian Banking Association to discuss the potential solutions in more detail of problems that we all share as a larger community. I'd like to hand over now to the session moderator, Elling, who will introduce the panel in more detail. Thank you.
Thank you very much, Andy. Much appreciated. Anna Bligh is the CEO of the Australian Banking Association. Elaine Grace is the CEO of the Actuaries Institute. And I failed to say hello previously to James Fitzpatrick, Chief Technical Officer with Allianz. Hello, James, and please make our panellists very welcome. Just a reminder that your questions come straight through to me on the iPad, so use that QR code. Elaine, we might start with you. We've been hearing over the course of the day and over the course of some years now about the fact that the more granular the information you can gather about the risks that an individual property might face in terms of general insurance, let's say, the more you can actually precisely identify the risk and then price the risk. And that movement obviously has all sorts of implications in terms of how you price that risk. What are you finding in your most recent report about home insurance affordability, given that, those who are in vulnerable positions are so much more exposed not only to the natural elements, but to the reality of their position?
And hopefully, yeah, that's working, great. So look, this is our third report. We've done a lot of work since 2020 on home insurance affordability. And the key thing is, as you said, there's more granular understanding of the risk at a household level, and that's obviously causing affordability problems. But I think the key thing about this report was, well, what does affordable and unaffordable look like? So the thing that we defined it as was, well, relative to how your gross income, how does that look? And what we said was, well, unaffordable certainly at 4 weeks of gross income seems like a lot. So our latest report shows that 15% of households have a home insurance premium which is greater than 4 weeks of your household income. That's 1/12 of your wage. I'm saying it slowly, that is a lot of money. That means 1.61 million households have that. So naturally, South East Queensland have the greatest number of households with extreme affordability pressure.
And it's obviously also a reflection of your household income, right? It's not only the risk, it's the income.
So it's about their socioeconomic as well. And this is the point, I think, that we've heard from earlier conversations, looking at this concept of who's most vulnerable, and those households with low income are least resilient anyway to be able to deal with these disasters. Southwest Queensland, Northern Rivers of New South Wales, regional Western Australia, Northern Territory, they've got the highest proportion of affordability pressure. So we're really seeing this issue coming through. And again, going to the vulnerability, in a previous report, we looked at, well, who are these people? They're over 60, they're retired, they're single, adult households, low savings, so less capacity to deal with this issue. Now, again, it's worth saying that at least 70% have, that household premium around 2.5 weeks less, which seems reasonable. But what do we do about this concentrated risks for this area where the risk is so high, and we are having a more intelligent conversation now? The premiums reflect the risk, but the risk is so high that it's completely unaffordable.
And then I think it's also, you keep making the point as you go, that the intense risk which we can now map, is getting worse and worse. So it's up 30%, right?
Yes.
In terms of the impost on those households, the risk relative to their household income. But then overlay home loans on top of that. Then what does it look like?
So this year we extended it to look at, well, what was the impact of home loans? And I would like to call out Surendra Padam, the author, who's here with us today. But look, we looked at the 2.3 trillion home loan market, and an estimated 5% of households with a mortgage face extreme home insurance affordability pressures. That's 180,000 households, representing 57 billion of loans. So the problem with this is twofold. Obviously, well, they won't be having it in home insurance, and obviously to have a mortgage you should have home insurance in place. So that's the first thing. But I think we're also obviously seeing the banks are increasingly reporting on the impact of climate change to them. So they're looking at, well, which parts of their mortgage portfolios are vulnerable to this? What does that mean for their practices? Yes, they may be, assisting their current vulnerable mortgage, the people that they lend mortgages to in these situations. But what about the next lot? What about when those people try and sell? How does this trickle through? And I think we will start to see it trickle through the financial services much more as the regulators look at it, as banks look at it and get more of an assessment. And ultimately, what does that mean for customers? What does that mean for these people in vulnerable situations?
Anna, I'm just getting a little silly because I got outside too late to get a cup of coffee. So I've only had sugar and not coffee. But it's sort of like trying to get your young men. You've raised 2 young men. I'm nearly finished raising the second young man who's going to finish his last QCE exam on the 31st of October. But it's like personal hygiene in young men, right? You can impress on them the need for personal hygiene, for shampoo and for flossing, but you've got no way of actually ensuring that they've done that. And that's the difference, isn't it? Increasingly, if you're going to use that metaphor in risk for financial industries, we can now tell whether or not they've done it. So you are required to have insurance in order to take out a mortgage. Elaine's just made the point, Daniel Molino made the point earlier, that your members have got this huge exposure, this 60 billion in people who, they took out the insurance, they probably dropped it the next day after they refinanced or they got the loan. Do you care at this point? When does that start to affect people's access to credit? She's so stunned by the question. I'm so sorry.
Well, first of all, I was going to say that in my experience, you can tell when young men have not exercised appropriate personal hygiene, and you can tell pretty quickly. But it's much more difficult in the insurance field, I will concede. And I'd also counsel you that the raising doesn't stop when they finish the QCE either. Look, it is something that that Australian banks care about. It is something that is important to them, at a macro level, from the point of view of the sort of stability of the system, the strength of their insurance book, and depending on their own risk appetites, making sure that they're running an appropriately risk-balanced bank. But it also matters to them because when it goes terribly wrong, it's their customers who have catastrophic life experiences. And so this is an issue that is increasingly exercising the minds of CEOs. It has been discussed several times at length at our ABA boards with our ABA bank CEOs sit. So this is something that is definitely in the kind of top 5 or 6 of issues that CEOs are turning their mind to. And it's becoming an issue that's taking this kind of attention because of the affordability issue. It has been the case forever that banks have expected that when you take out a mortgage that you will appropriately insure the property because it's the security on the loan, and it's also prudent from the point of view of the customer. And when insurance by and large has been, by and large affordable, the issue around people being in these sorts of highly stressed and potentially quite perilous circumstances just hasn't been. It's not that there's never been anybody who hasn't insured because they didn't want to pay or they couldn't pay, but the numbers have been so small, it's been very manageable. And I think this is a really important discussion, but I think it's also important for us to not overinflate the issue either. I'll just clarify, but my understanding was that you're saying the total exposure of 57 billion is the current actuarial estimate of households with a mortgage that are not insured. But there's a subset there. How many of those are living in high risk and perilous areas? And I don't know what that number is, and it would be interesting to get some actuarial thinking on it, because I suspect it's much, much less than that, which does not mean that it's not something we shouldn't be working on. And it's something that I think we are, at the banking level, worried that unless the affordability issue can be adequately addressed by other public policy measures, then that number will continue to rise. And that is something that I think would be, is something we need to get ahead of. I would say that APRA did 2 years ago a climate vulnerability assessment. It was the first time that our prudential regulator had done that. They did that across the 4 major banks, and I think from memory they had one non-major bank involved. But it was a way of stress testing the system in a very serious series of extreme climate events. What would this look like? Interestingly, they basically, there was a lot of good advice for banks about what APRA expected, and I think both APRA and banks learnt a lot through the process. But overall, what APRA found is that while there is a growing risk, it is a risk that is being well managed. It is a risk that banks, that in terms of a risk to the long-term stability of the system, that they were satisfied that sufficient was happening. Now, that doesn't mean that that's 2 years ago. What does this look like in 10 years' time? You've got to be thinking about that now. And that's, as I said, one of the things that banks have put on the agenda for us to, start to be working with the insurance industry to better understand who is this group of people that are uninsured, because there's other reasons than climate vulnerability that people might not pay their insurance. It may just be that they've lost a job, or they may live in a perfectly safe place on the top of a hill that isn't in a fire risk zone. Most people do in this country. But what is the size of the problem? Where is it geographically located? And then I think we'll have a better understanding of how do you protect people better? What are the public policy issues that need to be addressed? What are the banking policies? What are the insurance policies that need to come together to better protect that group?
In other words, the risk, the idea of ongoing verification, ringing up every client or contacting every mortgagee every year to say, hey, how can you send me a certificate of currency on your insurance, is a huge piece of work. And that level of risk abatement, if you will, isn't warranted given the risk as it is right now. Is that basically it?
I think that's a fair assessment. Banks are required to, and they do, send an annual reminder with your annual mortgage statement. By and large, a home is the most expensive and valuable asset that most Australians are ever going to own. And overwhelmingly, they insure against that. But as affordability becomes more and more of an issue, and it's not only the issue about affordability of insurance right now, it's against the backdrop of other cost of living pressures. So mortgages repayments are higher than they were 2 years ago. Everything else is going up, so that's putting pressure on that affordability issue as well. We'd hope to see that abate at some point. So yes, you want the solution to be commensurate with the size and nature of the problem. Now, it may well be that we've reached a point technologically where we can find ways to make that, to limit the inconvenience on customers and to make the cost to both insurers and banks such that it doesn't add something that ends up making other banking services or products or insurance products more expensive. So you've got to find a solution that's commensurate to the size of the problem. And it may be that it needs to be much more geographically targeted than across the entire population. Yes. But the insurance is, the security on the loan. So it is something that is critical to prudent banking, and it's something that's critical to consumer protection. So, we are absolutely dedicated to getting this right, but I don't think the answer is just as simple as
that
as it
degree
might
of
seem.
intervention. Okay, and James, I'm interested. So this is one piece of the whole widening protection gap, which is a global phenomenon we've been hearing all day. Ever since, I mean, that was striking listening to the Canadian example and thinking, yes, tick, tick, tick. You were recently part of that ICA delegation to hear more about the challenges. What did you come away having learned about what drives the widening protection gap and what lessons we might draw from what other people have done to try and close it?
Yeah, so it was a privilege to go on that delegation to the US and to meet with a range of stakeholders that we had the opportunity to talk to. I think obviously this is a consistent problem globally in terms of what's happening, and the recent hurricanes in the US are clearly examples of some of the affordability challenges and how they're unfolding. I think where you get the real learnings is where you see the differences in terms of how different systems operate. And I thought there were sort of three areas I'd touch on. The first one was really stark in terms of how the various stakeholders across the US had completely different perspectives on their insurance system. And I might touch on the Californian Earthquake Authority as an example. So that was established, I think it was in the late 90s or the mid 90s, in response to an earthquake and insurers withdrawing from the market, and established, and the Earthquake Authority themselves had a really good understanding of what they do and don't do. There's a $150,000 typical deductible that is before anybody gets cover, so a very significant burden if there is an earthquake that you have to pay first before you sort of can start to think about then what is the Earthquake Authority helping to solve. But also only covered a very small percentage of the Californian households, and there isn't really a private market solution. So the vast majority of California is uninsured for earthquake. Then when we talk to various stakeholders, the sort of mindset a little bit is, oh yeah, earthquake, that's solved. The CEA's got that, and it's sort of the same thing, but on the flood, which is sort of the states would sort of say, oh well, the feds have got the flood covered under FEMA, which when we spoke to FEMA, the 6% coverage in terms of the national household portfolio in America. So you've got an awfully large uninsured problem, but a very low level of understanding of what the issues are amongst the various stakeholders. If I contrast that to what I see within our context, I think we've got much better understanding and a much better common understanding of what the issues are, and the maturity of the dialogue is a lot more advanced. But it did, in terms of takeaways for me, that was one in terms of the power of making sure we keep that. We talked a lot about data. It's been really prevalent in the conversation. I do think it's important, and to keep that facts in the conversation to kind of focus on how do we drive solutions. The second one was just how individual, question to one of the members of Congress in the US around how do you think about the fact that you've got 6% of people covered by FEMA and 15% of people covered in California for earthquake, and it's kind of like, not so much, we think about that and really the uninsured and the gap in the protection gap, but the response was sort of, well, we're not going to force people to buy insurance, that's their choice. So you sort of had that real American cultural, this is their choice, it's their freedom of choice, and not so much a focus on the affordability and how that's playing out and what it would mean downstream post-event. So, and I think for us, there's a real lesson in this, and we spoke a little bit about the data in terms of the increasing granularity and what that means for affordability and the increasing push that has to the individual. And I think it's really important that we kind of figure out how to get this balance of what's the community part and the pooling part of insurance versus the individual. And we're probably not that strong in that. When we talk about a lot of these issues, it's very much where collectively we've got people living in a really high risk situation, which arguably is through no fault of their own, and it's their individual problem often in terms of how the insurance experience manifests. So I think there's something in that. And then the final one, which I think is possibly a little bit more evident to people generally, just where we've seen a lot of government intervention in the US, it really did lead to insurers withdrawing and actually growing some of the protection gap problems because the regulation and trying to control.
And was that regulation or price control that drove that?
It was price control, coverage control, and probably the primary two things.
Yes.
Yeah,
which is not likely to happen here, right? So what you're saying is fascinating. In a way, they're so much more individualistic that they say, it's your problem, you sort it out. But in lots of ways, if you think hard about what we're doing, it's quite American.
It is,
Right?
and this is, I think, a real challenge that we have to stare into as an industry, because if, as a community, we don't want to stand for having these individuals left behind, then we do need to find a collective solution to that, which kind of comes back to the first point around how do we find the collaboration that we need across all parts of stakeholders that are involved in it to pick up this issue. It was interesting. One of the comments actually made in the banking sector was that people just give back the keys. So what happens if they lose their home? Well, they give the keys back to the bank, and they move on and start again.
Jingle mail.
Like, one of the things I liked about when we released our report, people actually cared about the fact that vulnerable communities, needed to be helped. Whereas in America, I don't think it's necessarily quite like that. It's like, survival of the fittest. It's a different.
No, I was going to ask. So when there are earthquakes or big fire events that people in that kind of volume are uninsured, does the government in any way become effectively the insurer of last resort? I mean, do they provide assistance to people?
They do to an extent. There is a federal federal disaster relief, and I can't remember the exact name for it, that's enacted by the federal part that goes in and helps people. But it's subject to the presidential order determining that this is a catastrophic event of a certain scale. So if it's not, then you're on your own. But then there is a degree of support available, but not anywhere near what people
replacing your
need.
house.
Yeah.
No, and it is quite political, isn't it? So then when you hear, again, we're talking about vulnerable communities, vulnerable because of where they're living and the fact that that's more likely to be a low socioeconomic community building in a floodplain on cheap land and so forth. Then when someone like Daniel Molino and his committee are wrestling with the idea of, he was talking about the line moving, right, between the individual beyond mitigation, just down to that actual question of reinsurance, where does government intervention come in? You scratch your head about things like that, okay? You're the technical person on that one. How would you even conceptualise something like that for Australia, given that Elaine's just identified for us how many people we might be talking about, and Anna's asked some even better questions about, okay, exactly where are they and who are they and why are they vulnerable, right?
Yeah, and I think this comes back to this common understanding of the problem and how do we get everybody to lean in and help with a solution. There's no individual part of the stakeholders in these problems that can solve that. You see public-private partnerships in this that operate around the world in a range of different things. We talk about American on one end, which is quite individual. Thank you. Individual. No, I'm not going to try. And then on possibly the other end is sort of a model where the Swiss model where everything is very much community rated. It's compulsory. Losses are shared amongst industry. So there are solutions where you can look at how do we distribute this in a different way across stakeholders and how can various stakeholders chip in. It's critical to that, though, that you have an exit strategy. The FEMA, the flood agency in America, was established in 1968, and talking to people about why was it established, what was the problem they were trying to solve, no one can remember. But they all think it doesn't do it anymore, and it's not effective. But the critical lesson there is that if we start something, we need everybody to participate and help, but we also need to know exactly what we're trying to achieve and how we get back out of that as we make communities more resilient.
You need to be so disciplined in its implementation, and that's when the political considerations, because that just led to a lot of developments in beaches in Florida and stuff, which is not what the outcome you want. So you still need the discipline of price signals, clear lines on where you shouldn't develop, all of that stuff as well.
Think more for me in terms of, you've looked at the scale of the problem. The overwhelming thing that's coming through on your research is actually that insurance is quite affordable. Like it's working well.
It's working well for most.
Yeah, it's
Yep.
working well for most. So then, if you've stared then hard, Elaine, at who's vulnerable, what sorts, as you're putting all that together, what sorts of solutions spring to your mind about what might be done about these folks, given that yes, you know, as affordability gets more difficult, the problem grows, but it's a very small problem to start with.
So you need to be very targeted, and I guess it goes to some of Anna's comments as well. You don't necessarily need to do solutions to everyone. Target on where the problem is. So all of these joint partnerships, the Hazard Partnership Initiative is great. We need to share the information between a lot of people. I guess where we see more needs to be done is around sustainable finance, particularly in adaptation. So the rules aren't existing at the moment where you can get, you know, climate, you do have things like, you need to have climate adaptation bonds. So how can you get the finance industry to start funding some of these that will, you know, help make it more resilient for the banks, help make it more resilient for the consumer, for the insurance. And that way, where you can't make it more resilient and there is no adaptation strategies, government can step in and, you know, contribute their money towards those solutions. So kind of split the problem. But as much as you can give momentum to that personal, to the finance industry for sustainable finance, that's a good solution.
There's a great question here, Anna. What are the banks considering future climate risks to homes before providing finance? And if not, do you think they will in future? And I note that on page whatever it was, I just quickly read through Elaine there, 23, the CBA did that work,
Yep.
where they identified this much in their portfolio is exposed to bushfire and this much is exposed to flood and so forth. So at what point does that start to impact decisions on who to lend to?
Let me say, at the right now, and really probably for some time, I think there's been an element of where there have been incidents that will start to affect valuations of property. And so when banks make a decision around lending, many of you will know it's subject to a valuation. And if the valuation, if it's in an area where there's been several critical incidents, that I think will affect the valuation of the property. So it's not that they're necessarily going out to assess it on a climate risk, but there already, I think, is an intersection between the valuation of the property, you know, and the price of the loan. But in a more formal sense, Australia's banks, but particularly the four major banks, have signed up to globally to something called the Net Zero Banking Alliance. This was a result of the Glasgow conference, and that Net Zero Banking Alliance, those banks globally that sign up to it basically have made public commitments within a period of time, and that will, it's coming up around sometime in the next year to 18 months. They will publish they will set and publish targets in their business book and their mortgage book around, you know, how they're going to adapt their banking practices. So, you know, I don't think we're about to any moment soon, you know, have a situation where banks, you know, wouldn't lend, for example, to a customer in Lismore. But I do think that we'll start to see an intersection between public policy, where governments start to say that there has to be some point of disclosure by real estate agents or vendors, that customers will then start saying to themselves, oh, do I really want to buy somewhere where this is, you know, within the floodplain?
Can I afford this cheap house?
Can I afford this cheap house?
Right.
Now, some people are going to say yes. They're going to decide to take the risk. You know, there hasn't been something for 20 years. I'm going to take the risk. But I think more and more customers are going to become savvy about this as well. So, you know, I think it's not just about banks. I think there'll be a range of policies that will ultimately intersect, and a range of signals to customers, because, you know, banks, you'll have to talk to your insurance company about getting insurance and find that, oh, gee, that's a really expensive house to insure. now I've been advised, as I had to be under law by the real estate agent, that this is within a flood zone. You won't stop everybody from buying in those circumstances, but over time, I think, and I think you can expect banks to be saying to customers, and some would be doing so already, you realise this is in a flood zone. There's been some major events here in the last 5 to 10 years. Do you want to think about what the resale value of this property might be if there was another event in the 5 years? I mean, I think they're conversations. You know, they're not, we're never going to lend to you. It's, have you really thought about this?
Listening to that, James, any reflections on that before we move on?
It's interesting in terms of some of the things we see out of Europe in particular, because the EU has probably pushed a little bit harder in terms of regulation and also thinking around some of this. And they've really got a concept around energy efficient mortgages, I think it is, EEM, and which is sort of emerging out of the banking sector over there, and quite a number of banks providing that as a solution. And it really starts to consider the resilience and the sustainability of the house in terms of how they're setting up the mortgage. One of the things that underpins that is that the partnership into understanding some of the risk settings around that sustainability assessment is becoming stronger. So I do think there's possibly some areas where we'll see some of those things hopefully get shared as global practice around.
What you're saying is you can only do that if everybody's got the data, if everybody understands the same risk. Same set of circumstances.
It is super helpful if we've all got a common understanding of risk, because when we start having these conversations that Anna touched on around, well, what's the resale value?
Yeah.
Someone's holding that house right now, right? So the real estate, you know, that asset, and what's the fair way for that to be recognised, and whose data are we relying on? And a public asset around that, I think, is something that is really useful to have a common view of the risk for all of those reasons. Mm-hmm. Yeah.
And just to jump in again, I think if you're going to do it in a way that's meaningful for the community, it has to be really simple. I mean, I think it does have to come down to, it's actually very complex data, but I'm sure that there's very complex data behind the thinking about whether my washing machine is efficient, water efficient or not. But I can tell by a star rating. I don't need to understand any of what went into that. And I can have confidence that this star rating has got to meet certain standards, and that I can have some confidence that I'm getting something that's, you know, going to reduce my water bills, for example. And I think there is a role for government there in terms of, that is, in this country, government is still a trusted source of data. And I think having a uniform understanding, whether you're talking to your insurance company, whether you're talking to your bank, whether you're considering buying real estate, right now that data there's no uniformity, and to the extent that it is available, if you really go and research, it's not simplified in a way that I think is very customer friendly.
And I would so agree with that, because I think this is the problem. We're obviously seeing a huge tipping point. So climate mandatory reporting has come in for all of the big companies. So they're all going to be reporting much more on what their exposure is, what they're doing about it. They're going to be held to account. We're obviously seeing these premium pressures means that there's much more informed conversations happening by individuals at the barbecues, you know, with government. It's getting much better. But there still isn't just that source of what does each household is exposed to.
But what you have to do is look up any address, ring any insurer, and ask them for a quote. There you are. There's the answer.
It goes back to your
$100,000. You can't afford the cheap house.
But we're hearing diversity. For example, you know, new immigrants are coming in. They've got no idea. They buy the house. So, you know, what duty is it for?
But I'm actually being quite serious. You know, they say, what's your estimated loan repayment on this is on realestate.com. If there was a demand to say, well, we went to 3 big insurers and we were required to put a guesstimate of what it would cost to insure this building on this piece of land, we have that information. I mean, you don't need to reinvent the wheel, right?
No, absolutely. And I think it's... In many communities, it's very, very common to go and quote a whole range of insurers before you buy something. So we get told stories of that all the time. So the trouble is it's for those that understand and know to do that, which is not everybody. Yeah. So yes,
like your building inspection.
Correct. Yeah. So it
Yeah,
does
right.
need to be something that is far more standardised and made available.
Yeah, yeah. Well, you'd only need to require it, right?
But there is also, remember, a group of customers who already own properties that are in these circumstances.
And they get the shits when you say
Yeah.
yours is in a flood zone,
Yeah.
notwithstanding the fact that there are ducks in the backyard.
Yep.
Yeah.
And they've been paying their insurance at an affordable rate for maybe 20 years. And then a massive event comes along and it goes from here to there. And that's where I think there's a real difficult issue.
Yes, absolutely. Thinking about the role of the finance industry, banks and insurers in incentivising local resilience, like the Resilient Building Council's tool. Just any views from the panel on should there be a role for the finance industry in that? Is that something that you guys should be dealing with at all?
Well, I'm happy to jump in first and say that there are a number of banks now that are also already offering lending products to incentivise people or to make it possible for people at at reasonable rates where they can to do things like put on solar panels.
Yes,
or,
there's some very good products around.
There's certainly, because that over time increases the value of the property. So there is that's an emerging field. I mean, most banks are doing something in that area. And I think, this is not something that was very much on their agenda maybe 10, 15 years ago. But when you think about what those products might look like in 10 years' time, they're going to evolve. And I think there is a role, and I think there'll be a customer demand for it, and that will create those, smart people in banks who invent products when there's a customer demand. So that, I think, is certainly going to happen. But it doesn't, I think, necessarily deal with those customers who are in a building, and a lot of them are going to be, people who are on very low incomes, the value of the property might actually be quite high. They might be people who are retired, who've owned the property for 30, 40 years, they've not that long paid it off, but their income is actually very constrained. So, I still think there's a role there. There's a public sector role of some kind, or going back to James's point, how do you think about this in a way that fairly attributes the cost and fairly makes it possible for people? Because I think there is a very, the large, home-owning group of Australians, the largest group of those are going to be able, I think, over time, where necessary, contribute to making their property more resilient, because it will become, I think, something that is more valuable in the market than it is now. So, the same way as if you decide to spend money on renovating your house, you make a decision not to renovate it so much that you won't be able to sell it and get your money back, but you sell it, you renovate it within a reasonable... if you got to a point, going to James's kind of examples about in Europe, if you got to a point where star ratings or some kind of an energy rating had a value, then that would drive a lot of different behaviour from both customers and lenders.
Just before I get to you, James, the minister was saying that household resilience program, is that national or is that just for North Queensland? But I think there's people in North Queensland taking that. It's in terms of strap your roof down. Forget about the gold taps in the bathroom, strap your roof down. Led to, I've just written 13% reduction in insurance premiums, right? So to what extent would you anticipate the impact, what sort of impact would that have, those sorts of programs have, could they have on that red line data that you're identifying of people who increasingly can't afford their insurance?
We haven't estimated, but look, it's a good thought. But I guess I'll just comment one thing. So we're definitely a big supporter of the resilient building rating system. I think the next push towards insurance companies, and we've seen it in some of the recent inquiries, is, so if I spend this money on adaptation, exactly what reduction in insurance premium am I going to get? And so I think, again, this is the next stage
Bring
of
up and
advancement.
ask.
Yeah.
Sorry.
No, I think it ties together a lot of things. As we've touched a few times earlier in the day on the Hazards Insurance Partnership and those sort of vehicles in terms of having the public-private partnership, which can provide the education platform to inform people around what are their options, what can they invest in, what does it mean tangibly from an insurance perspective, and then obviously individual insurance companies having the innovation to be able to respond and make sure that that's part of their competitive offering. So,
I know you're not representing the ICA, but to what extent, how good are insurers at that? You'll understand the technical nature of that question, but you're also an industry generalist. How good are you guys at actually going, oh, you did this? Okay, we'll give you that discount.
Oh, I think there's room for that to improve, but I also think that there's a genuine appetite for insurers to want to do this. This is something that, you know, the industry generally and individually advocates for resilience and is keen to make sure that the support is there for doing that. I think the biggest challenge is doing this at scale in a meaningful way, such that the investment in systems and processes and clarity is something that can be made available to everybody in terms of what these choices look like. I think with some of the government initiative where we've had funding made available for householders to tie down roofs, that makes it a lot more palatable because the economics for the householder are much better when there's that partnership with government as well as the industry.
The other thing is building codes. I mean, Australia's actually done a very good job, I think, when we have had major catastrophic events. We've done a good job of thinking, well, what do we learn out of that? And you know, what we learned out of Cyclone Tracy was that if you live in the northern part of this country, that could happen to you. And we completely changed the Northern Australian Building Code, North Australian Building Code. And that happened over a decade. But I can tell you, having been into those post-cyclone communities, you can walk down the street and you can tell which houses were built after Cyclone Tracy and which weren't. You know, if they're an old Queenslander that was built in the last century, they'll be smashed to the ground. If they're built to the new building code, they'll probably lose their front fence. If they didn't put the braces on their roller door, they'll lose that. But they don't lose their roof. They don't lose their windows. So there's resilience and there's resilience. There's things that you can do like that and strengthen the bonds on your roof, etc., that will protect you better against a cyclone. But if you live on a floodplain, there's real restrictions and challenges on what you can do. The Brisbane City Council here, there's a suburb called Rocklea that if you live in Brisbane, you'll know it. I think it's actually, you know, I don't think there's ever been a flood that hasn't flooded Rocklea. Because it's actually below sea level. And the Brisbane City Council provided grants for homeowners in that area because there's a lot of old Queenslanders there to lift, to raise them. And a really high percentage of people took up those grants. And post the 2011 flood, many of those houses still flooded over the rooftop. They couldn't have lifted the houses any more than they did. So there's some real there's risks that you can mitigate, and building to new fire codes will also help, as I understand it. But I think we've got to be resilient. Building in resilience is really critical, but I just think we've got to be really realistic about whether there are some places that people shouldn't live.
And I think we need to be ready that when the disaster happens, we know what the next solution is. So in other words, so we're ready to go in there with the blueprint of solutions, because that's part of the problem. The disaster happens and everybody's going, well, what do we do now?
Yeah, that pre-agreeing how we're going to have recovery, I think, and it sort of comes back to that we need an exit strategy comment around if we have schemes or different things. That pre-agreeing is fundamental because communities come together often post an event, and it's a moment where they've got a lot of purpose around let's rebuild our lives, and we see that time and time again, and we just repeat the problem. So,
although I think the example of Lismore was a very good example. While there were very tough conversations there, I know Andrew was involved in them and sat on that grouping up there. They had really tough conversations about, I don't think you can live here anymore, that people, found very hard to hear, but other people were enormously relieved to hear. And as a community, they kind of worked through the grief of that and came out the other side of it. I wondered to what extent your own experiences, Anna, coming out of 2011. You know, I remember writing a story trying to get people's interest in flood mapping, which, was a hard sell to the Chief of Staff. You want to do what? And I said, well, nobody since Ludwig Leichhardt went missing, the German explorer, nobody else pretty much went out and mapped. And so, they had one quick look for him and that was the end of that. But that was an enormous amount of work that was done by the Queensland government at that time to get that information together, and that really supercharged us, didn't it, into the sort of conversation we're having today about, Daniel Molino saying somebody's walking up and down with an iPad down a street in Lismore and they say who's covered, who's not covered, and they know exactly the granularity of the risk of that because of the work with LIDAR and all the rest of it. I just wonder how long it's going to take us, and I suspect not very long, to get to the sorts of systems that recognise the homeowner's contribution, the community's contribution to resilience, and really rewarding and increasing the transparency around what the risk is and what you've done to mitigate it and how can you be rewarded for that. That doesn't feel that far off to me.
Look, it's a really good question and one I've reflected on, because one of the reasons why I think the 2011 flood was so shocking and so devastating was that actually Queensland had been in drought in the years leading up to it for a long time. And we were at the point where we were about to run out of drinking water. And it had been 40 years since Brisbane had flooded. And therefore it was something people talked about as ancient history. But actually 40 years is not a lifetime. This is something that people had in living memory, but they had nevertheless forgotten it when they'd gone to buy and sell houses. And my memory of that time and now is it takes about 10 years for people to forget. And now what's different is that since the 2011 flood, there's been another one and another one and another one. And so something that was seen as quite extreme, unusual and rare is increasingly on the political agenda as actually, regrettably, this is becoming what we can expect in summertime in some parts of this country. And therefore, and I think that will be a helpful thing. I mean, as much as I wish that that wasn't the case, that we were going to experience those events, unless you are experiencing them with sufficient regularity, they just drift off everybody's must-do list because other priorities, hospital waiting times, need to build new roads, all of that just takes over. So, and not just for politicians, but for the community. So I think it will be less time for that to turbocharge than we had after 74. I don't think it'll be 40 years.
That was a wonderful discussion. Please thank the panellists very much, Anna, Elaine and James. Before we wrap up and move to networking drinks, please thank our session sponsor again, Tenon, for their contribution. Thank you very much. So that is the formal proceedings for today. The fun bit starts. The networking drinks and canapes are on the Sky Terrace. I have no idea where that is, but there are people from the ICA outside who will point you in the right direction. And Andrew Hall is upstairs to provide some closing remarks. Thanks so much.